So we have done till difference between equity share and preference share. This we have done, and the topic which we were continuing was owner fund. So in owner fund we have learned equity shares, we have learned preference shares. Now these three topics remain: retained earnings, GDRs, and ADRs. So third topic is retained earnings. Now what is retained earnings? See, we are doing financial statements in accounting, and in the previous chapter we have prepared trading and profit and loss account and balance sheet. So can you tell me what result we get from the trading account? What result we get from the trading account when we prepare trading account? What we will be able to find out? Yes, very good, very good. Obviously, we will be able to calculate gross profit or gross loss of our business. Now, after that, we will prepare profit and loss account. So, what is the result of preparing profit and loss account? What I will be knowing after preparing profit and loss account? So, from profit and loss account, I will be able to calculate my net profit and net loss. From trading account, I will be knowing gross profit and gross loss, and from profit and loss account, I will be knowing what is my net profit or net loss. Now, if suppose I have earned profit, means net profit. In that case, now we are discussing these points from the point of view of company form of organization. But first you tell me, for proprietorship, who will get that profit? The profit which is earned by the sole proprietorship firm, who will get that profit? To whom that profit belongs? The profit which the uh, business has earned in case of sole proprietorship, to whom that profit belong? Yes, obviously the owner of the business, or you can say the proprietor of the business. Yes. Now, in case of company, who are the owners? In case of company, who are the owners? This point you have, yes, obviously, but mention the category also. Yes, yes. Equity shareholders are the owners of the company. Now, as the profit belongs to the owners of the company, obviously, so whatever profit is there, that remains after paying interest on the borrowed funds as well as preference dividend, whatever amount of profit left after that, and after paying tax also, that amount of profit belongs to the equity shareholders. Till here, all the concepts are clear. Whatever we have discussed right now, it is clear. Now, what happened in case of company? Company has a choice. Suppose company has a balance of profit of rupees 100 after paying interest, after paying dividend on preference shares, and after paying tax to the government. Now, balance of profit is rupees 100 with the company. So out of that 100 rupees, because company has to earn, company require a lot of funds for its expansion or for its activities that they have to arrange from some outside sources. Sometimes what happen, they, because this 100 rupees you have generated with your own effort, so you may invest this rupees 100 also into your business, and then you don't need to arrange funds from the outside sources. So it may be there is a combination that, like, out of 100, companies paying rupees 30 to the equity shareholders, and 70 rupees company retained with itself only. However, this whole rupees 100 belongs to the equity shareholder. Equity shareholders have full right to get rupees 100, but this is their own business. So sometimes company retains some amount of profit earned into the business for the purpose of its future financial requirements, to fulfill its future financial requirements. So that earning, that profit which company has retained for this purpose, instead of distributing that amount to the equity shareholder, that is termed as retained earnings. That is termed as retained earnings. Yes, meaning of retained earning is clear. Now see the first point. It refers to that part of profits which is kept as reserved for use in the future. So whatever profit you have earned, out of that profit, if some part of profit has been kept for future financial requirements, that is termed as retained earnings. The earnings which has been retained by the company for its future financial requirements. It is also known as internal financing or self-financing or flowing back of profits. Means, because you have not got that amount from any external source, it is owner's money. So that's why it is also called internal financing. You have earned your capital and then you have invested it into your business, and that's why it is also said flowing back of profits. Means whatever profits you have earned, you have again invested that amount into your business. Third point is, it is shareholders fund and not an external liability. So because you have earned your profit and you have invested that money, retained earnings. Now the next thing is global depository receipts. Now first read its content, then I will explain it. What is it? It is an instrument. Like equity share is also an instrument. Preference share is also an instrument. Debenture is also an instrument. Bond is also an instrument. So these are financial instruments. So global depository receipts are also a instrument issued abroad by a company. Obviously, a company can issue global depository receipts, and where it can issue, not in India, it, outside India. It should be issued abroad. Why it should be issued? To raise funds in some foreign currency. Like you can take example of ABC Limited. Now ABC Limited need funds for its working, for its functioning. So for that purpose, they have an option to issue equity shares. Now Indians can purchase that equity share. The foreign citizens cannot purchase equity shares of that company. But somehow, if company is good and its profits are good, so foreign citizens also are willing to invest in such company which can earn good amount of profits for them. Now, how they will get this opportunity? For that purpose, company can issue global depository receipts in their country, which they can purchase there. And purchasing and selling of that global depository receipt will be done on some of foreign stock exchange like Bombay Stock Exchange, Mumbai Stock Company listed on that particular stock exchange. Listed means the particular share should be in the list of that stock exchange. Only then you can trade there in that stock exchange. So second point is saying it is listed and traded on a foreign stock exchange. So it will be in the list of some foreign stock exchange where you can easily purchase and sell that receipt also. So if some company wants to raise its funds in some foreign currency also, for that purpose they will be issuing their global depository receipts in the abroad countries, and it should be listed on some foreign stock exchange. Yes, please. If you have any query regarding global depository receipt, you can ask. Now coming to the next topic, American depository receipts. So American depository receipts are same as global depository receipts with the exception that global depository receipts can be issued in any country outside India. But American depository receipts will be specifically issued in America. It is issued by non-US companies. So the companies which are not registered in USA, those companies can issue American depository receipts to the Americans in order to obtain, just a minute, some misprint is there, in order to obtain foreign exchange, in order to obtain foreign capital. And because it is issued for Americans, so obviously Americans will be able to purchase and sell shares in some of the American stock exchanges. Like one index is there Nasdaq and one index is there Dow Jones. Two famous indexes are there for American stock exchanges. Like in our country, there are two famous indexes are Sensex and Nifty. So the receipts, American deposit receipts which you are issuing to the Americans, these will be listed and traded on American stock exchange. So now I hope the difference between global depository receipts and American depository receipts is also clear, and the purpose of both is also clear. Now coming to the next topic. So this way we have completed owner funds. Now the next type of funds is borrowed funds. So in category of borrowed funds, first category is debentures and bonds. Now what is the meaning of debentures and bonds? Let's see. First we will do debentures. So first meaning of debenture is a debenture is a certificate issued by a company. So obviously debenture is a certificate which a company issues. Obviously company is borrowing some amount from you, and that's why company is issuing you a certificate acknowledging its debt to the holder. Acknowledging its debt to the holder. So debenture is a certificate which a company will issue. Why it will issue you a certificate? Because it is acknowledging the debt to the holder. Means suppose ABC Limited is there and they want to borrow some amount from the public. Now suppose I am giving them rupees 1000 as loan. So for that loan, they have to issue a certificate that this person has given us a loan of rupees 1000 at and in exchange we will be paying this much rate of interest on this 1000 rupees, on what dates the interest will be paid, and after how much time. It may be 5 years, it may be 10 years. After how much time the loan will be repaid back, on which date it will be paid back. So what are the contents of this certificate? The amount of loan given, rate of interest, and security offered. If company is giving any security also for that loan, obviously practically whenever you take loan you are supposed to give some security also. So whatever security you are offering, that will also be mentioned there, is mentioned on the certificate. So that particular certificate is technically called, the technical term for that certificate is debenture. Yes, please. So now I hope that it is clear to you that it is nothing else than a simple loan taken from the public. But when you take a loan from the bank, you don't need to give them any certificate. There will be a contract. When you are borrowing from the public, also this is also a contract. But in the exchange of that contract, you will be issuing them a certificate that you have deposited this amount in the company as loan. Now, second point is features of debentures. What are the features of debentures? Debentures are borrowed funds, and debenture holders are creditors of the company. Now you know the meaning of the creditors of the company. Those who are providing you credit, those who are lending you money or goods on credit, these are known as your creditors. So obviously, whosoever is giving loan to the company, that is also a creditor of the company. Then second thing is fixed rate of interest is paid on specified dates. So generally the dates are 30th September and 31st March. Whatever interest you are supposed to pay to the debenture holders, it is divided into two installments, two half-yearly installments, and the rate of interest is also fixed in the case of debentures. It is not flexible. Payment of interest is legally compulsory. Legally compulsory means that suppose you have started a business and you are the owner of the business. Is there any guarantee that you will be able to earn profits? If you have started the business and you are the owner of the business, is there any guarantee that you will be able to earn profits? You will be able to get in return something? No guarantee. But suppose you have borrowed rupees 5,000 from one of your friends or any relative, and you have promised that I will be paying 10% per annum interest on that. Even if you are not able to earn rupee 1 profit, the legal compulsion is that you have to pay interest of rupees 500 to him compulsorily. So it is a legally compulsory payment. So voting rights are only with the owners of the business. And who are the owners of the business? Equity shareholders are the owners of the business. They will finalize each and every activity, each and every action of the company. And that's why, because there are large number of equity shareholders in the company, it has to, activities has to be decided with majority. So that's why voting will be there for each and every thing, and on the basis of voting the things will be decided. But debenture holders have lended money to the business. They are not eligible to participate in the business activities or to interfere in the business activities. Now the next point is debentures have to be redeemed after a fixed period. Obviously, whenever you are borrowing a loan, the tenure has to be decided for how much time you are borrowing the amount. So on the certificate it will be clear on what date the amount will be returned back. Debentures are secured by charge on the assets of the company. Now this is a very technical term, secured by charge on the assets of the company. Now what does it mean? See, a few minutes back I told that whenever you are borrowing any loan, you are generally supposed to furnish some security for the safety of that loan amount. If somehow you are not able to pay the amount on the due date, or you are not able to pay the amount back, then the person who has given you loan has the right on the security provided, and he can sell the assets which you have given as security to recover the amount given by him as loan to you. So that's why debentures is also the amount of loan. Debenture represents the amount of loan taken by the company. So they also sometimes get a security, and that is called secured by charge on the assets. Technically, we call it that a charge on the assets has been created. A charge on the assets has been created means that the debenture holders, those who have given loan to the company, has a right on the assets of the company, specific assets of the company, to sell them if somehow company makes any default in the payment of the loan, in the repayment of the loan or interest. Yes, please. Any query regarding features of debentures? If any point is not clear, let me know that. See, again I am explaining. Fifth point, debentures are to be redeemed after a fixed period. See, companies in case of debenture, who is borrowing? First answer me. In case of debentures, who is accepting the loan? Who is borrowing? Yes. Company is borrowing. Company is borrowing money from the public. Company is borrowing money from the public. Now, when you are taking loan, you have to tell the purchaser of the debentures that after how much time I will be repaying back your loan. What will be the date? When you give some amount, when you deposit some amount in a fixed deposit with the bank will tell you the due date of the fixed deposit, the maturity date of the deposit. That will be written on that certificate also. If you have ever seen that certificate, the maturity date along with the maturity amount, what amount you will be paid back, that is also mentioned on that certificate. The same case will happen on the debentures also. They will be writing a maturity date on the certificate, on what date the repayment of these debentures will be done. Now it's clear. So that's why it is written here that debentures have to be redeemed. Redeemed means returning the money back. Redeemed means repayment of the loan after a fixed period. So that's all from my side today. And